Okay, awesome. Okay, well, welcome. I'm so happy that you guys were able to come in today. We're gonna go through the PowerPoint on here. Let me just pull up mine. Whoops, nope, that didn't work. I always have a problem with this. I don't know why. Um, but this is what we're going to be going over today. So just let me know if you can't see anything, and I will stop the share and try again. We're going to be going over key factors that are going to be affecting interest rates for your buyers. We're going to go over mortgage insurance, credit myths, and mortgage products that are going to fit your borrower's needs. I'm also at the end going to send you guys the buyer's book. It's generic, so you can make it your own. I have it as a link in my signature for my buyers. And it kind of like just breaks everything down for you. So basically, what our borrowers should be expecting from us as lenders. So first and foremost, integrity and professionalism. You don't want to be yelling at your borrowers. I know sometimes they can be frustrating, but you want to make sure that you always handle everything with integrity and professionalism. You need to return those phone calls and emails and texts. Now, everybody is a little bit different about how quickly that should be done. But if somebody calls you at 9 o'clock in the morning, you should really make it your goal to return that phone call within 4 hours. If somebody's texting you and you can't speak to them right now, politely text them that you will look into something for them and get back to them later on. But you don't want, this is one of the biggest pet peeves that borrowers have, is that they don't feel that we respond fast enough. Okay. So you want to try to set those parameters with your borrowers as to, the communication that you're going to be having them. Let's remember, it's the power of communication that makes things work really well. You want to be able to answer all their questions clearly. If you don't know an answer, the best thing to do is say, listen, let me look into that. I don't want to give you incorrect information, and I will get back to you as soon as I get the answer. But always try to respond to them. You want to make sure that you are staying informed at all stages, which means that you and your processor or your LOA need to have a specific schedule of when they're going to report to you the status of things that are going on. I have always had weekly meetings with my processor. They're very busy, but a weekly meeting of 30 minutes to 40 minutes to go over your pipeline is imperative. And you need to also make arrangements with who is going to be contacting your borrowers through the stages of the mortgage. You want to make sure, in some cases, if you have arrived, you can set up automations that actually will go to your borrower and state, your loan has been submitted to underwriting, your loan has been approved. There are like automated messages. Now, every LOS system is a little bit different, and sometimes you may have to do this manually, especially if you're using one of the older LOS systems, such as Byte. You want to just make sure that your borrowers understand that they can feel safe with you, that you have the knowledge to resolve any problems that may come up. Generally speaking, you don't want to use the word problem with your borrowers, but make sure that if there is a situation going on, that you call your borrower and say, listen, there's a delay in underwriting, or your loan had to be manual. Give them an update, even if it's just to talk to them. Don't ignore the elephant in the room. Borrowers want to know what's going on. This is a very nerve-wracking situation for them. And if they're not getting responses from you, that makes them feel very nervous. So even if you don't have something positive to say, you still want to report and say, I'm sorry, there's a delay. We're working on it, and I will get back to you as soon as we have the situation resolved. Don't leave them hanging. This is one of their biggest pet peeves. It's one of my biggest pet peeves. You got to deliver good news. Everybody's always happy to deliver good news, but when there's some bad news, people tend to not want to address that. And you have to. And you have to work with your borrowers consistently to make sure that everything is moving forward. And of course, you need to meet all of those contract dates, okay? Especially here in Colorado, we have specific dates. Have them marked, have your processor put them in your LOS system so that no dates are going to be missed. This is very important for our realtor partners as well as our borrowers. So now what would we expect from our borrowers? Well, first and foremost, we need them to provide any information that we are requesting within a 24-hour period. So you need to set those expectations right up front when you are working with your borrower. I need you to work with me to make sure that I get all the documentation that I need. Now, there are borrowers that are going to have pushback. I don't want to give you all the pages of my bank statements. Why do I need to give you 4 pay stubs or 3 pay stubs? Or I gave you that already. Why do I have to give it to you again? We need to just set those expectations for the borrower, for them to understand that our lenders are lending out a tremendous amount of money. And we have guidelines that are set for us that we don't have the ability to change. If a borrower doesn't want to give you tax returns, or they don't want to submit income or certain things, we have what we call non-qualified mortgages for people that would prefer not to use tax returns. But they need to understand there's still documentation that's going to be needed. So make sure you set those expectations. You want to be reviewing all the disclosures before your borrower signs them. 90% of us as loan originators are not doing that. We send the package to the borrowers. The borrowers are sometimes blindly signing these disclosures. You don't have to go over all 40 disclosures that are going out, but you need to make sure that you are going over the main disclosures with them. And you need to also set those expectations for when you're locking them in. Are you locking them in the beginning of your mortgage application? Make sure if you're doing that, that you look at the closing date. In some states, such as New York, closing dates are on or about. In other states like Texas or Colorado, where we are in Florida, you have an on or before closing date. On or before means you're closing on that date or before. On or about, if you're in a New York, Connecticut, New Jersey state, means that you generally want to close by December 1st, but you have a 30-day leeway, so you may not close until January 1st. So make sure, depending upon the state you're in, that you look at the contract and make sure before you lock that person in that you're not going to be shorting them on the lock-in, okay? And make sure that you always speak to your borrower before you lock the loan in. We know rates change every day. Some of us who are very seasoned in the industry, Mike, I think you have seen this. We have seen rates change 2 and 3 times a day. When I was a loan originator in the 90s and things were so volatile, there was a time where the stock market actually froze because interest rates jumped up over 1% in one day. So make sure that you're educating your borrower that the rate that you are quoting them today is only good for today. So if they don't lock in today and they want to wait until tomorrow, you cannot guarantee the rate's going to be the same. And that is even on your non-QM loans. They don't change rates as quickly, but they are still following the market. And so you don't want to get lost in that. So make sure that you are having a conversation with your borrowers. I personally, being that we work for mortgage brokers, 90% of us prefer to lock my borrowers in rate up front. And if the rates come down and my lender is not willing to float down the rate, I am prepared to pull the loan from that lender and send them to a new investor and lock the rate in at a lower rate. That is one of the benefits of working with a mortgage broker. It's not, a lot of us will be like, that's not fair to the investor, but that's part of why we're mortgage brokers. We have the ability to shop for our clients and secure a rate and make sure you know the float down policies. Sometimes we have really great float down policies with our investors, and sometimes the float down policies are not as great as they should be. But you need to educate yourself about your investors' float down policies, and the fact that you do have to, always stay competitive. So that's basically how I've always done this for 38 years. And it works. You don't get your hand slapped if every once in a while you have to pull a loan from an investor because their float down policy is not conducive to the market. All right. You try to negotiate with them first. If they're not willing to negotiate and you have the time to pull the loan and send it to another lender, that's what you're going to have to do because we work for our borrowers. You want to also make sure that your borrowers are following the house rules. So what do I mean by house rules? Well, we need to educate them. Please do not buy big ticket items while we're in the process of doing your mortgage. Big ticket items are cars, boats, anything that I'm telling you. I had a client years ago make an offer on a house. There's a reason why we look at inquiries on credit reports, okay? There's a very important reason why we do that. And he had an inquiry on his credit report with Mercedes-Benz, and I specifically asked him, did you buy a car? Oh, no, we were going to buy a car, but we didn't. He lied to me, okay? We did another credit report prior to him closing, which is at the discretion of the investor. And lo and behold, yes, he did. He purchased a brand new Mercedes at $850 a month. And there was nothing we could do because he no longer qualified for the mortgage. So you have to be really diligent about going over with your borrowers the house rules. Do not open any new credit. Opening new credit will lower the credit score. Do not pay off any collection accounts. A lot of times, collection accounts don't need to be paid off. There is no guarantee if you pay off a collection account that the interest rate is going to go up. As a matter of fact, a lot of times the interest rate, or I'm sorry, the credit score, not the interest rate, the credit score can come down if you pay off a collection account. So don't advise them to pay off collection accounts unless the underwriter specifically calls for it. And even more so, do not let them pay off installment loans. Once you pay off an installment loan, that loan closes out and that good credit is no longer contributing to the credit score. So these are myths that people that are not in our industry don't understand. So you want to make sure you're going over that with your borrowers. Same thing. We don't want them to close out any of their credit lines. Paying down a revolving account, a credit card is fine. Generally, that will raise the credit score. But if your borrower closes that account, again, you've just closed off a good account that's contributing to a positive credit score, and it could lower the credit score, and that would affect the interest rate. It could affect the whole loan qualification. So let's, make sure that they know. The other thing, cash deposits. You have to have that conversation with the borrower right up front. Cash deposits are a problem, okay? Now, if it's a cash deposit of $500, generally you can write a letter of explanation. We were saving some money at home. We just deposit in the bank, and that's fine. But what if you have a cash deposit of $5,000? You can't document a cash deposit, and therefore what happens? The underwriter is going to back it out. So you need to have the conversation with your borrower. My grandparents were notorious because they were, they raised their children during the Depression of hiding money, literally hiding it in their mattress, hiding it in their shades, hiding it in their Bible. When my grandfather passed away, we found over $5,000 of cash that he had hidden in different places in the house. This was an old-fashioned mentality because of what happened during the Depression. But people still follow these rules, okay? A lot of people save cash at home. So if they have cash at home, we need to know so that we can properly inform them as to how to deposit it into the bank or hold on to it and maybe get a gift from somebody and then you can pay them back after you close. But cash deposits can be problematic. So if you just give them the house rules, let them read the house rules, that's really all you have to do. Co-signing. This has been another deal breaker, okay? Borrowers that co-sign for their children are obligated on those loans. So it's not always collect 12 months to show the child is paying that, okay? Sometimes if they are late, you can't waive that. And now you have to have them hit with that deposit. And if they're looking to co-sign during the mortgage application, this is a great time to say, please, can you hold off on that? Do not co-sign for anybody while you're applying for a mortgage. Of course, obviously, we don't want them to fall behind on payments, okay? Late payments, that's going to be a problem. And number one, do not change your job or how you are paid without having a conversation, all right? If you go from W-2 to 1099, we cannot use that income. Why is that? Because 1099 is variable income and we need a 2-year history. W-2 is stable income, generally speaking. They're going to get the same paycheck every week. But 1099 is basically a way of filing Schedule A or Schedule C, and it becomes more of a self-employed situation. So if they're going to be changing the way that they're paid, let them do it after they close on the loan. If they're going to change jobs, that's not normally a problem unless they're taking a job that is going to pay them bonus income or 1099 on top of their salary. You could only use the salary. So again, you want to make sure that they understand that during the time, and generally speaking, it's 30 days, okay, from the time they apply to the time that they close, that they should not be changing jobs. It's a conversation. If you just mention to them, hey, listen, I just wanted to say, while we're doing this, it's best not to change any jobs. They may say, oh my gosh, I just got a job offer and I was going to take it. They don't always think to call their loan originator. Why should they ask our permission to change jobs? So it's about the education of what a borrower should be doing. Again, power of communication. Now, no borrower, as we all know, is the same when it comes to interest rates. I did a loan for 2 brothers. One had really great credit and one had credit. And they got me on the phone at the same time to say, how come we locked in on the same day and I got this rate and he got that rate? It's an educational thing. You want to explain. There are different key factors involved in quoting interest rates. Number one, your loan to value. Are you putting 3.5% down, 5% down, 20% down? Did you know that if you put 15% down and takes a small amount of PMI insurance versus putting 20% down, that the interest rate at 20% down is actually higher than at 15%? Why is that? Because at 15%, they have PMI insurance. At 20%, they're right there at the top tier before you need PMI insurance. So this has a lot to do with your interest rate. The loan term, a 30-year interest rate, is going to be more than a 20-year interest rate. A 15-year interest rate is going to be better than a 20-year interest rate, and so on and so forth. All right. So the interest rates change based on the terms. The loan type, I think we all realize that. The loan type, whether it's FHA, VA, or conventional, which would be Fannie Freddie, can vary. All right. There may be reasons why you need to go Freddie because they have maybe less stringent guidelines than Fannie Mae. Now, normally speaking, Fannie and Freddie, their pricing is usually the same, but sometimes there can be a variation. If you work for a big bank like a JP Morgan Chase or a Wells Fargo, you will see the difference because you get paid differently. So you're going to see the Freddie pricing and the Fannie pricing. Here in the broker world, where we are, generally speaking, our investors and lenders keep it an even playing field. And so picking Freddie over Fannie might have to do with like a first-time home buyer program, or it might have to do with guidelines pertaining to trust income because they vary a little bit. And then mortgage insurance. Again, like I said before, you could have somebody that puts 15% down, and they're going to have mortgage insurance, and their mortgage interest will be lower than the person that puts 20% down. Okay, so it does impact it when it comes to the interest rates. So we all know basically what mortgage insurance is, right? It's a policy that protects the lenders against loss in case the borrower does not make their mortgage payments and they default on that mortgage. Mortgage insurance does not have anything to do with your borrower. It's about the lender. They're lending this money. It's a higher risk because the borrower didn't have the down payment. All right. And so they get insured and the borrower pays for it to make sure that if there is a foreclosure, that the bank is not losing a ton of money. Now, a lot of times we miss this in the industry as brokers, okay? We usually do not shop mortgage insurance. And a lot of times when you're structuring a loan, you should be looking at the different options you have for mortgage insurance. You have borrower paid mortgage insurance, and that's a policy that's going to reimburse the lender if the borrower defaults. And generally, the lenders, like I said, require this on anything that exceeds 80%. You have single premium. I have used this many times, especially if they don't have the full 20% to put down. Single premium is a one-time payment. It is counted as a closing cost, but a closing cost that actually could be paid by the seller with a seller concession, okay? So, and they'll get the lower rate, and they don't have to make any monthly mortgage insurance premiums. And it also keeps their payment lower. So if you were in a marginal situation where they weren't qualifying, a single premium may be a good option. And you can do a single premium up to a 95 LTV, but the higher the LTV, the higher the single premium is going to be. Radian has a great website where you can actually price out all the different options for mortgage insurance. And so I have used the single premium to help my borrowers keep their payment lower and to stay qualified. You also can do that with lender paid mortgage insurance, okay? This is mortgage insurance that your lender is paying on behalf, and it's going to be incorporated into the interest rate. So you may save $250 a month on a mortgage insurance payment by going lender paid, but they're not just going to pay it out of the goodness of their heart. They've got to get the money from somewhere, and that's going to be from the interest rate. But sometimes the interest rate may only go up a quarter or maybe a 0.5%, and you've got to look at the difference. Does it make sense to pay a monthly MI, or is it better off if I just have the lender pay it for my borrower to keep that monthly payment lower. Sometimes, guys, it's not always about the best interest rate. Sometimes it's about that monthly payment and what we can do to keep that monthly payment lower. So you do have options. I do encourage you, if you're a member, go into our archives. We have a training that Radian did for us a few months back on the different options of mortgage insurance. And you could just use their website just to kind of price it out. Everybody's a little bit different, but in basically mortgage insurance are pretty much close to the same when it comes to quoting. So you could use the Radian website. You don't always, especially as a mortgage broker, get to pick who your mortgage insurance company is going to be, especially if you're using tech companies like Rocket or UWM. They have special deals with a specific mortgage insurance lender to give you discounts. So they're only going to offer you a few different options, which you can find on their websites, but you don't get to pick what mortgage insurance company you're working with. But it is a tool when you're structuring a loan that can be very valuable to you. Now, of course, we do have other types of mortgage insurance. For those of you that do a lot of FHA loans, you know that they have an upfront mortgage insurance of 1.75% of the loan amount that you can incorporate into the mortgage. So if the down payment's 3.5% and they're actually financing 2.15% of the mortgage insurance in there, your actual loan to value is going to be higher, and they permit that. That's why we do it that way. You're taking that 2.15% and you're spreading it out over 30 years. It's very minimal. Okay. There is the option, if the borrower wanted to pay it up front, they could. And then if they refinance, they would get a portion back depending upon how many years before they refinance. But generally speaking, it's just not worth it. And of course, on top of that one-time MI that they collect, you also have your monthly MI. Now, last year, FHA lowered it from 0.85 to 0.55. So if you have somebody that maybe has a 680 FICO score, they're only putting 3% down, and the MI is really, really high on a conventional, I really encourage you to compare the conventional with the FHA for two reasons. One, the Ginnie Mae rates that are, the Ginnie Mae bonds is what FHA sells into. The FHA rates tend to be lower than the interest rates for Fannie and Freddie. And so if you don't have an excellent credit score, 720 and above, the mortgage insurance payment for conventional could be significantly higher than 0.55. And so you could be saving your borrower a good $100 a month, if not more. So make sure you're looking at the credit score and you always compare FHA and conventional, because that 0.5%, we can figure out how to get the extra 0.5%. That's not too difficult. And of course, in the FHA, another change on that guideline was you don't pay that monthly mortgage insurance forever if you put less, if you put more than 5% down. It will drop, or 10% down, I'm sorry, it will drop off automatically in 11 years. All right, so that's very important to remember as well. Let's see, we also have the VA funding fee, sorry. And for those of us here in Colorado, like Mike and I, we deal with a lot of military, okay? And a lot of veterans. You want to know if they are disabled or not, and that will show on their certificate of eligibility, because if they have any kind of disability with the VA, the funding fee of 2.15% is going to be waived, okay? You're going to waive that, and then they're getting 100% financing. And again, VA interest rates are going to be, much lower than conventional interest rates, again, because they are selling into a Ginnie Mae bond, which is different than what conventional rates are selling into. So again, FHA, you've got the 1.75 that they got to fund up front, and that's spread out over the 30 years, and then 0.55. VA, if they are not disabled, will pay 2.15, depending upon the down payment. So if they're putting nothing down to 5%, it's 2.15. Remember, if they're refinancing, oof, it's 3.30. That's a little hard. That's pretty hefty. If they're putting more than 5% down, less than 10, it goes down. So just make sure you follow your grids on that, okay? Now, credit myths. This is another place where we want to educate our homeowners and maybe even our realtors to a point. There are actually still some people that think that when you turn 18, you're assigned a credit score. That is not true, okay? You have to build a credit score. We in the industry realize this, but people that aren't in the industry, we can't assume they know what we know. So again, this is in the borrower book that I created that I'll be sharing with all of you. You know, credit myths. All credit scores are calculated the same way. Experian is going to be different than, let's say, TransUnion, which is different than Equifax. And then you have FICO scores versus Advantage scores, and they are all going to be slightly different. Okay. So again, just a little education for the borrower to understand that no credit score is going to be the same. We will get this a lot. My bank said my credit score is 796. Okay. That is just what your bank is reporting on the bank statement. That's what they're looking at. Okay. That is not your true middle FICO score. And so you have to be careful. You want to approach it delicately with your borrowers because credit is a very personal thing. But you want to make sure that you do give them some education that there are different ways of calculating your credit score. This myth, you can build credit faster by using more of your credit limit, is unfortunately a myth that is still out there that people are doing. And this is so not true. Ideally, using over 30% of your available credit or carrying a balance that's higher, that's close to your credit limit, could actually hurt your borrower's credit score. That's why when we have somebody, let's say they have a 670 FICO score, we need them to hit 680. You look at their credit report, we have the option of doing a what if and a wayfinder to see if they pay down a credit card, will that boost their credit score? So you might see on their credit report that they have a Sears card and the balance is $1,000 and their credit limit is $1,000. Well, guess what? If they pay that down by $700, there's a good possibility that their credit score is going to go up, and you can do a rapid rescore, which can be done in 7 days. So you have that tool in your pocket with your credit companies. Always discuss with your lender whether or not they offer it or allow you to do this. Okay. You cannot just do this without the permission of your company, but it is a tool that is available to us. And it's been very helpful for me with a lot of my clients because I don't even sometimes run it through rapid rescore. And it's like, oh, wow, you have this, this, and this. If you can pay down $1,000 worth of debt and give me proof of it, we'll do a rapid rescore for you. But you do have tools with your credit companies called Wayfinder and What If, where you can actually go in and Wayfinder will tell you what they could do, and What If lets you go in and actually change balances, remove collections. How would it look if we did this? How it's a great tool. And I urge anybody that's working with somebody that's right there on the cusp of looking into that tool, because it could make you the hero on your deal. All right. Checking your credit score hurts. Okay. We get this a lot too. That's actually not completely true. All right. We have light inquiries and we have hard inquiries. So In the mortgage industry, the first inquiry of a mortgage hit is going to be a hard inquiry. For 45 days after that, your borrower can go to any other lender and have their credit checked, and it will not lower their credit score because it's called a light inquiry at that point. They're specifically given a 45-day window to shop rates. They don't want their credit scores going down every time they go to a lender. All right. And the lender, of course, can't use the credit report somebody else ran. They have to run their own. So if somebody says they're marginal, I always say do a light inquiry, don't do a hard pull. Let's see what the light inquiry says. All right. And then that gives you a baseline. But checking your credit score for personal knowledge with Credit Karma, things like that, it's not lowering the credit scores, okay? Shopping for rates on loans can lower your score. We just went over that. Comparing rates on home, auto, and student loans during a small window, 45 days, is enough time that it will not affect their credit score. All right, this is another situation that comes up. When can you buy a house following a major credit issue? Okay, now we have non-qualified mortgage investors out there that say we will close on your loan one day out of bankruptcy. Okay, that's true. All right, but with that comes large down payments and high interest rates. For the purposes of going conventional, Fannie, Freddie, FHA, VA are traditional mortgages. This chart right here shows how long your borrower would have to wait, okay? So with Fannie Mae, if they have a foreclosure, it is 7 years from the trust deed date, okay? 7 years. So if your borrowers are foreclosed on, they may not be able to buy a house with Fannie or Freddie for 7 years. Now, of course, this depends on the type of bankruptcy, okay? With the FHA, it would be 3 years, VA, 2 years. USDA, which is our rural government loan, will do 3 years, all right? Short sales, okay? What is a short sale? A short sale means that the property was underwater, the bank had to take a loss when the borrower purchased it, and so that will stay on your credit for 7 years, but generally 2 years with 20% down, you can go Fannie Mae. After 3 years, you can go FHA, and so on and so forth. If the short sale is 10% down with the conventional, you're looking more at 4 years. So again, if people have a short sale on their credit report, you need to check the date. Chapter 7 bankruptcy. Okay, it's really important to know what type of bankruptcy your borrowers applied for. Chapter 7 means that they did not repay their debt. The debt just got erased, okay? And in that case, 4 years conventional, 2 years FHA, 2 years VA, 3 years USDA. Now, if they filed Chapter 13, that means that they paid back their creditors over a period of time. They are more liberal on this bankruptcy. So with Fannie and Freddie, you're looking at 2 years. With the FHA, you're looking at 1 year, okay? Same thing with the VA and same thing with USDA. So you need to know what kind of a bankruptcy that they did file in order to be able to distinguish which program they would be able to fit into. Again, we have mortgage products that fit everybody's needs. We have conventional, we have which is Fannie and Freddie. We have government, which includes VA, FHA, and USDA. Then you have your non-QM, non-qualified mortgage, which is generally used for your investors, self-employed borrowers that can't qualify under your traditional guidelines. So that includes your DSCR loans. That's for investors only. They must own their own primary house in order to get approved for a DSCR loan. Bank statement loans. This is very popular for our self-employed who have everything written off on their taxes, but can provide 12 to 24 months of bank statements that show the average deposits. You need to get with each individual investor because these are private investor loans and they set the parameter for the guidelines. So no two investors have the same guidelines. So find your favorite DSCR investor, your favorite bank statement investor, and stick with that investor for those programs that, like, I personally find some conventional lenders who try to go into the non-QM field are going to have a lot of overlays on their non-QM products because they are high risk. So there are people that they only do non-QMs, start with them first, okay? P&L loans and 1099 loans. I love the 1099 loans. And they are great for our Schedule C commission borrowers. You just give them the 1099 and that's what they're going to be using. Some will want a letter from the accountant about, how much deductions there are, but those are really nice, easy loans to do for your self-employed borrowers that may not qualify with their tax returns. Now, I always do urge you to look at their tax returns if they're willing to let you look at them. Come into the loan support room. There are things that we can add back in where they may actually qualify, and they don't know that they can qualify because they don't know you can add back in depreciation. They don't know that you can add back in mileage or home offices. So it's always good to try to see if you can get your self-employed borrowers into a conventional or Govy loan before you go non-QM, okay? So our next mortgage mastery workshop that I'm going to be doing is next week, hopefully. I will have my CRM working properly again so that when you register, it will give you the link. We're going to be going over this, is going to be basically decoding those mortgage disclosures, understanding the purpose of the disclosures that go out to our clients. We know that they get 30 to 40 documents that they have to sign in a mortgage application. There are some that don't really, they're just general disclosures, but there are some that are really important, like the loan estimate, the closing disclosure, timing requirements. So we're going to be going over all of these things next week. And again, if you have people that are, you want to bring in your realtors or your borrowers so that they understand the disclosures that are going out, this would be a great workshop for you to attend with them. So I have done a lot of talking over the last 44 minutes. Do we have any questions? Just unmute yourselves and ask away. Oh, come on, I wasn't that thorough. Hi, Oscar. How are you? Is Oscar in there? Okay. Okay, so if you don't have any questions, I will send you all, Cami, Michelle, Oscar, and Mike, I'll send you the buyer's book. If you want the link, if you have Canva and you want the link to Canva, I'll send that with you as well, because then you can go in and actually edit the book and make it your own. And like I said, if you download it into your Google Drive, you can get a link and then you can actually put it in your signature. And your borrower, when you're communicating, can actually click on that signature on that link and they can download the book. So, and I think it's a really valuable book. I just updated it a little bit, but like I said, make it your own. Okay. And always remember you can come in and talk to me and ask any questions you have during the day if you're trying to structure something or aren't sure about calculating income. All right. So you all have a great Friday. Enjoy your weekend. And I'll see you next week.
Thanks, thanks, thanks. Love the
Oh, you're
class.
so welcome, Mike. It was so good to see you. All
You too. Have
right.
fun.
Everybody take care.
Bye.
Thanks.
Bye.